Hi everyone, my name is Sonja. As Rob kindly introduced me already, I'm an economist and digital advisor at the IMF.
And I'm Majid Malaika. I'm an IT officer, a cybersecurity subject matter expert working on the emerging technologies in terms of security as well.
So I would totally walk around and have a real conversation with you guys, but I think the mic is forcing me to stay here. So I'm just going to stay here and chat to you, and hopefully we'll get enough time for questions. By raise of hands, how many of you know what the IMF does? Okay, I guess I don't need to explain, but basically the IMF is like the lender of last resort at an international, global level. So there's central banks, if you will. We are concerned with global economic and financial stability, and to do so, we assess our members, of which we have 189, economic health. We give them practical advice, and we lend them when nobody else wants to lend to them. So the IMF has done some research work on central bank digital currency. If you haven't checked it out yet, please do so. There's an interesting staff discussion note that was published last year in November on a high-level view of central bank digital currencies, their impact on monetary policy mainly. What a couple of us, an interdisciplinary team, wanted to do next in follow-up was to give it a bit of a more of a nuts and bolts flavor, to really get into the details of like how do you operationalize a CBDC, because it's nice to talk about it, but it's even better to actually apply it in practice. So just to give you an idea of what the paper is going to be about, these are obviously not all of the topics that the paper is going to cover. We have also like project management considerations, legal and regulatory considerations, a legal tender discussion. But these are some of the key topics that we wanted to present to you today and that are probably most relevant for our paper. So what is a retail CBDC? And there is no agreed upon taxonomy or definition that everyone uses. We're just going to go with it's a widely accessible digital representation of a fiat currency that is issued by and liability of a monetary authority, which is in most cases a central bank. And more importantly, it's legal tender. I think it's important to keep that in mind when you put it into perspective with other means of payments that we've try to do in this chart in our money matrix. And I know there's like the money flower and the money tree, and we're coming up with the money matrix, but we thought this view is useful because it kind of shows you like, okay, so what? Like, what is the added value of having a retail CBDC? So it's not only central bank issued and legal tender, but in comparison to cash, for example, it has also programmability options, meaning you can program it to do anything you want, really, right? Like to use it as an effective monetary policy instrument, for example. On this map here, you can see the main players in the field, like what countries have already started exploring retail central bank digital currencies. In blue, the ones that are most active. In orange, the ones that are exploring and are confirmed, and in red, the ones that are unconfirmed, meaning we only have secondary source information about their activity. And of course, this is just a snapshot in time as we're speaking. Now, maybe this has changed, so just be mindful of that. We're keeping a very close eye on it and try to update it as we go, but this is basically the most recent version of it. So why are central banks thinking about issuing a retail CBDC? And I think this is one of the, if not the most important slide today. So you have probably heard the case of Sweden and a dwindling cash usage, something that is really important, especially for advanced economies, where countries have experienced like a dwindling use, especially of small currency domination. And Sweden, I think, is a very good example because it's going through exactly that at the moment. And in that context, CBDC can provide a robust alternative, right? And it can also help mitigate adverse impacts from private payment system monopoly distortions, right? Like, because as private issuers enter the scene, they might might create monopolies that can really distort the whole picture in the economy. There's a potentially lower cost and operational risk to issue when issuing a CBDC. Issuing and managing cash is expensive, and it's also not safe. Think about an island where you have to ship cash from an island to an island, can get intercepted by pirates, and boom, it's gone, can't be traced, can't be retrieved. It's just gone. Now, of course, there's a high fixed cost for issuing retail CBDC, but we do think that the marginal operational costs of CBDC will be lower. To me personally, the most compelling use case is financial inclusion, super important for economies that deal with geographic remoteness or dispersed remote areas where it's just not commercially viable or profitable for incumbents to engage, where there's no proper network or internet, and they're probably not interested in providing services there, whereas the central bank has a vested interest in providing ubiquitous access to all of its citizens, regardless of where they reside. Then finally, some central banks are thinking about how they can use CBDC to monitor illicit activities. And this is particularly important for, there's a requirement on monitoring and reporting illicit activities under the anti-money laundering, counterterrorism financing international standards. For that, so in that context, CBDC can be very interested because obviously you can't monitor your cash as well as you could do with a digital representation of your currency. There's the potentially improved security and trust in payment systems. We say here potentially because, of course, this will imply that there's a fundamental trust in government institutions or in the central bank. This may not always be the case in some countries, but of course, it's always nice to have the central bank as the backstop and not like a private issuer where you don't really know what happens if they go bust, right? Particularly important for consumer protection, we believe, because regulation may not always have your back in terms of data privacy. So in that regard, possibly interesting for protecting your privacy and your data. And if there's one thing I want you to walk away with today is that we're not advocating that the CBDC is a silver bullet and the be-all, end-all of payment means. It's actually, there's alternatives to it, right? There's enhanced payment infrastructure, fast payment systems. I think this girl over there mentioned the FedNow. It's a viable alternative. It all depends really on what the use case or the problem is that the central bank is trying to solve. So how can a central bank digital currency be issued? Like, what's the process? We try to show that here using 3 different operating models. So in the first one, I'll try to use, you can all see the first one. The central bank would manage the entire process from issuance, distribution over the payment system. And in the third one, it would just do the issuance piece and leave the distribution and payment system to private institutions. Now, of course, it's obviously more appealing if the central bank does it all by themselves, like in the first model, but that also means that it's a much more involved and a much more complex process, and possibly for most instances it exceeds the core mandate of a central bank because they get involved with possibly wallets and apps and all of that, which is not something which they're necessarily familiar with. We believe that there are key design principles and country-specific design principles. On the key design principles, we consider them foundational and independent of the country or the project context. So they kind of have to be there. And then there's the country-specific design principles that will very much depend on the project context, the country context, and the policy objective that the central bank is trying to achieve. So as you can see here, these are some of the country-specific design principles that we jotted down. The first one particularly relevant for countries where large segments of the population lack proper identification and cash is king, right? So for them to use a retail CBDC, it has to be designed in a way it makes it appealing enough where you don't have to show your ID when you want to wire like $5 or something, but also like compliant with AML CFT requirements. And so a possible solution would be to say, okay, for infrequent and small amounts, you don't need an identification, but for everything exceeding a certain threshold, you need to show some ID. Then the CBDC could be an interest-bearing instrument to incentivize adoption. Really interesting also from the perspective because you as a central bank could totally impose negative interest rates and without risking a major shift into cash, right? We have not seen a CBDC with that design feature, but certainly what we would recommend is to allow that option and build that option into the design so that it can be enabled at any point in time, as opposed to excluding it from the initial design. Then the offline functionality is something that is really interesting, and I'd love to pick your brain on that. We know that the Riksbank requested that in the RFP, so whoever is bidding to design their CBDC needs to have that offline capability built into the design. And the PBOC, I believe, as well claims that this will be included in the design, but we have yet to see how that will work. How many transactions can be done offline, in what manner? And of course, you know, the main question is like how it will work in terms of like updating the central ledger, syncing up with it, that is. And finally, the most important point I think on this slide is that really it should be independent of a specific technology choice. We think and we strongly reaffirm that with our members that the choice of technology should come last, at the very last decision. That should be the last decision point. Because, you know, there's a lot of hype out there. Central banks get approached, especially central banks in emerging and developing economies, they get approached by all sorts of vendors. They want to sell in their technologies. And, you know, there's just a lack of knowledge. You can't really distinguish the hype from, like, reality. So we always advise to be very cautious about picking a technology first. And then finally, these are our fundamental design principles, the ones that absolutely should be there, no matter how you want to design, what your country-specific context is, right? So cybersecurity, probably the key design principle, and Majid will talk about that in a minute. And then also the user centricity aspect, like taking the user on a journey in an iterative and agile manner is something that might be novel for most central banks, but it is really important to ensure successful adoption. And then finally, I spoke about the design flexibility aspect before. It's just precluding like costly reworks and a lot of work that will have to be done in case there's not enough flexibility built into the design, in case technology changes, the policy objectives change, or there's some changes in regulation. And particularly if retail CBDCs were to become like cross-border, enable a cross-border transaction, then the aspect of interoperability that will play an important role. Now over to Majid.
Thanks, Sonja. So to dig a little bit in one of the key design principles that we think needs a lot of work from central banks is basically the cybersecurity. And just to give you a little bit of a brief why, central banks hasn't been a technology company, hasn't progressed like some of the big tech, some of the other companies. So there are some of the challenges that they will face. Here's a little bit of an example, for example, the insider threats. When you're dealing with cloud services, when you're dealing with third parties and vendors, there is the potential of an insider threat. Of course, if you do the right principle, least privilege principle, and follow the best practices, you can defend against it. One example was the Trade.io, where someone was able to steal, it's an exchange market, someone was able to steal about $7.5 million from the exchange market because they had access to the encryption keys. The second thing is the shared vulnerabilities in cloud providers. This is an issue as well that they have to think about when they're choosing a cloud provider and plan for such events if it happens and how they can protect against it. An example is Cloudbleed. We saw it a couple of years ago where the edge servers in Cloudflare had a vulnerability where if you do a buffer overflow on their edge server, you're able to get some sensitive data spit out of the server from there. The third one is the hardware vulnerabilities. Although these are rare, but they're very severe in context. And the example is Meltdown and Spectre, where the Intel chips had a vulnerability where applications could steal data from the application, from the machine itself. And finally, application interfaces. We've seen this and we hear it all day long in the news, where you have the injection attacks, privilege escalations, and with central banks putting these systems out, they will have to have some websites and APIs for banks and providers to connect to. Encryption keys, I don't have to say much there. There is a lot of process that goes into the creation, the entropy that goes into the keys, the communications, the storage, and there are a lot of examples where failed storage of the keys or the creation caused a lot of losses. One example is the coin check, where they lost about $500 million because they had a flawed architecture where they had a lot of coins in their hot wallets and insecure storage of the encryption keys. So those combination made it very simple for hackers to attack or accessible. So we spoke a little bit about the sheer volume of the issues that they will face. But there's a little bit also that I touched on, is the shift of landscape for the central banks. Central banks is not a big tech, and due to the rapid change in technology, in our opinion in the paper, they're jumping into a technology at some point and putting a lot at stake that they have to keep in mind that the maturity of the organizations as they move along. There's also the open design versus traditional enclaved. We've seen a lot of organizations and governments have protected their way of protecting the perimeter and monitoring the ins and outs. With these new CBDC systems, we see a lot of distributed systems we're opening up, and there are some that are thinking of decentralization. So these are changing the way the designs are, and it has to change the way that we look at security in terms of protection. There's also the sudden expansion of attack vector. We've mentioned that they will expose some websites, APIs to have connections to these backend systems. So there is a little bit of an expansion of the attack vector for that sense. And the low maturity of the backend systems, we've seen some central banks experimenting with some of these technologies, and their experience was that these technologies are a little bit behind in terms of they have bugs, they crash, and there is not much documentation that they can rely on in building that sense. Now, this is moving fast, so hopefully we will get that one off the list, but it's still something that they're facing in that sense. And of course, we have the potential of zero-day exploits. This has been always there, but with central banks putting a lot of stake into their CBDC, it becomes an issue if they cannot react quickly to a zero-day once it is discovered and needs to be fixed as well. So we spoke a little bit of the landscape shift. So how do we take the approach to tackle this problem? So in the paper, we thought about, first of all, the agility of the way that they work. And what we mean by the agility, the rapid change in the technology itself, the issues that comes up and pops up, the use cases that are changed, the team has to be agile in such a way to move quickly and to adapt with change. So that's one of the things that they have to consider to move to if not agile. There's also the threat model mindset. So they will have to adapt. There are some central banks that are thinking that way, but most of the central banks are still behind there, that they need to start thinking from a threat modeling mindset. They take the use cases, they take the systems, and take that approach of an attacker with the right skills. And finally, we thought about breaking it into two layers in the implementation and the design to tackle that problem. The first is the business and process layer, where they should be doing a risk assessment and a threat model from a high level, from an early stages. Also looking at their gaps in the process, looking at their policies, revisiting their standards to basically adapt as the CBDC is coming along. And the second is the infrastructure and the application layer. This is getting into the details of the technology once it's decided, of the systems, of the architecture and the cloud providers, and doing mostly an architecture risk analysis there and a threat model as well. This diagram just depicts that you need to understand your target, understand the threats to that target, and then think about protection. We see sometimes, not in central banks, but we see sometimes people jumping into the protection without knowing their targets and without knowing their threats as well. And it kind of gets them off balance in that sense. So to wrap up, future considerations, Sonja covered on the design flexibility, and the reasons what we mentioned is the domestic legal framework and changes in the central bank objectives. But I think the one I wanted to highlight is the technology and threats. The rapid change in the algorithms. We've seen quantum computing taking a leap in the past couple of weeks with the announcement of Google. So quantum computing, it needs to be designed in such a way that the CBDC can adapt to algorithms when they are updated and upgraded, and also hash algorithms and the vulnerabilities when discovered to be fixed quickly. And finally, the obsolescence of some of the technologies, because we've seen some open source technologies going obsolete in one day by a decision. What are they going to do if they're reliant on some of these open sources as well? So these are the considerations, and would welcoming any questions and feedback. Thank you.
Okay, thanks folks. The way we're going to do this is because we've got two sort of discrete topics. We'll do a sort of economics policy question and then a tech security question. So who's got economics policy type questions? Okay, let's go for this guy.
So related to the previous talk from Bob, have you considered what's the real impact of CBDC with regards to monetary policy and more in precision? Does this also mean higher access to a central bank balance sheet? And related to your point around, yes, there are countries that might benefit from a CBDC because they're remote and financial inclusion is important. But at the institutional level, access to the highest credit worthy cash, which is a central bank cash, different from commercial bank cash. What does it mean to things like quantitative easing and monetization when it needs to happen at a large scale, and what it means to retail banking as a whole?
Excellent questions. Although I was told I shouldn't say that. Excellent or very good. But no, a very substantial discussion on that topic in the staff discussion note, specifically on monetary policy considerations, the high level impact that it will have. And I encourage you to read that. Happy to share the link with you once we get out of here. But the main findings are that the monetary policy transmission channel is actually going to be improved, right? Because in some countries you have attempts to really reach the citizens, but you can't do so because the intermediation of the banks, the commercial banks, doesn't really work that well. Either there's a shallow financial sector or they're highly concentrated. So really the monetary policy transmission can't work the way it should, meaning the monetary policy tools the central bank uses don't get to where they need to get. And so that always varies by countries, right? And not in every country, but in those instances where it is an issue, where this intermediation is an issue, we do think that central bank digital currency can actually improve the transmission channel. So now your question on the central bank's balance sheets, it all depends how a central bank wants to, what operating model it chooses. I've shown you we've shown you the 3 different operating models. So it can be designed in a way that you would just outsource the distribution entirely, and you don't really have anything to do with like opening up yourself to citizens, if you will. But of course, there's also ideas like that was most recently floated by some staff in our at the IMF of a synthetic CBDC, which will mean that private institutions can park their reserve accounts of the central banks. So yes, there are disintermediation concerns, meaning that the central bank may compete with commercial banks. But again, it all depends on like, is it really an issue in that economy, right? If the banks are not fulfilling the function that they're supposed to fulfill, then maybe it will make sense for the central bank to step in and say like, hey, I really want this to work. I really want financial inclusion for all my citizens. So let me step in and try this out. This doesn't mean that like banks necessarily need to go out of business. I mean, there's still like the whole large segment of lending, right? Like, I mean, I don't think that any central banks really wants to get involved into the lending side, although who knows, in the future possibly. But yeah, I do think that there's viable options that like enable some sort of collaboration between all the participants, where it's not just like a winner takes it all, and the commercial banks don't have anything, any role to play any longer.
Thanks, Sonja. So a tech question. Anyone? Okay.
So I have 2-in-1 question. Which country is the closest to building something that follows your principles? And the follow-up to that is, did any of the central banks share their insights with regards to design and implementation of digital currencies?
So the question about the design principles. So this is a paper that hasn't been published yet. So these are discussions that we're having with some of the central banks. Now, to answer the question, someone who's following the principle, the one that we've described, these are a learning thing that we are coming up, and we're coming up with the paper. So some are doing some level of these principles and really looking at the cybersecurity, for example, and other aspects, and some are a little bit behind. But most of them are still in the research phase. So in that sense, they still have time to recover in these some of the other areas that we're highlighting.
Who would you say is the lead?
Name?
I can take that maybe to Relief Majid, because so Central Bank of Uruguay has done a pilot. You might have heard about it, and it's quite interesting. They shared, their implementation partner shared quite a lot of details with us, which we're really grateful for. And they actually follow the first operating model, where the central bank managed the entire process. But of course, that's easy to do in a pilot environment, right? Once you get to production, you might want to think about shedding some functions as it gets too complex and difficult. So I would say Uruguay was really the first pilot, if you will. I mean, there's no one really in production yet. It's all like an explorative phase. We might see China being next, but it all depends. Like, I either have announced that there will be launching soon, but we have to see. I mean, soon is a relative term, so we'll just have to see how that unfolds. But yeah, as we were writing the paper, we talked to a lot of central banks and their implementation partners, and to see find out more specifics about the design. So we do have a lot of information, and we see really a variety. For example, when it comes to technology choices, the ECCU, for example, chooses DLT-enabled infrastructure, but others like Uruguay have not, right? So it's not just all about DLT, and we really try to be technology agnostic, and in the way how we phrase this paper is also very much underlying this view that like we don't want to endorse a certain technology, or we don't want to endorse a certain design, but we're just laying out the options that central banks have, and then they can pick and decide what works best for them.
Okay, folks, we've got time for one last one, so either tech or policy. Yeah.
Thank you. This is a very small question. So do you propose confidential or non-confidential digital currency?
So again, I think I really need to make clear that we're not proposing a specific, like, you have to do it like this or you have to do it like that. It's really, we're just giving central banks a range of options that they have, and then they can decide what works best for them depending on their policy objective or objectives. So as I mentioned earlier, for example, on the striking the right balance between compliance with AML and CFT and anonymity, I think one of a good solution could be that you allow infrequent small amounts to be anonymous, to be transacted with anonymously, and then everything that exceeds a certain threshold can require or should require an identification. So that's a possible avenue, but again, we're not really in the business of telling countries do it like this or do it any other way, but it's more about, here are all the options you have, and then depending on your specific use case, which really should be the driver of all the design elements, you will pick between the various options that we propose.